The real estate market is real wonky right now. Interest rates are going up, housing prices continue to climb, there's intense competition, so much so that when houses are hitting the market, they're getting snatched up almost immediately and for well over list price. And it's causing a lot of frustration with many first-time home buyers as well as those who want to move up in home buying purchases. So in this video, I'm going to talk about where we're at and where I believe we're headed into the future. So stick around because I'm going to get into it right now. Hey everybody, Dietric Williams, realtor with Compass in Baldwin Hills, California. Welcome to Info on the Go, the show where I give tips, tricks, and insight on how to buy, sell, or invest in real estate in Southern California. If that's something that you're interested in, please make sure you hit that subscribe button, ring that bell so you're notified when I deliver future editions every week on YouTube. Now, my team and I, we're getting inquiries from all kinds of people who want to just know what it's like to live, work, and play in Southern California. So if you're thinking about making a move, please make sure you reach out to us, give us a call, shoot us a text, send us an email, however you want to get in contact with us. Just know that we got your back with everything that's Los Angeles. Now, since the start of the pandemic, the Federal Reserve has ramped up its purchase of mortgage-backed securities. And they've done this to avoid a credit crunch and to make borrowing for consumers a little bit easier. Now, the last time they did this was just after the 2008 housing crash. Now, these purchases are increasing competition, or they have increased competition for bonds, and that's what has pushed down interest rates. Now, so far, they've purchased about $7 trillion worth of bonds, and a third of these are those mortgage-backed securities that I was referring to. Mortgage-backed securities are essentially an investment pool, and what it is servicers, or the GSEs like Fannie Mae, Ginnie Mae, and Freddie Mac, they take these mortgages and they bind them together and then they sell them off to investors in the bond market. So it looks something like this. You have a mortgage, I have a mortgage, our best friends have mortgages, we all have mortgages. So let's just say, all things considered equal, we have pretty much the same credit scores, we have the same debt to income ratios, we have the same loan to value ratios. We're pretty much equivalent across the board. So the GSEs take these similar types of mortgages, they splice them together, and then they sell them out into the open market to investors. Now the investors, they get paid every month. And guess who they get paid by? You guessed it, those of us who are paying our principal and interest. Some of that money goes to the investors. Now, the Fed has been buying these mortgage-backed securities as a way to increase liquidity inside the market. So just think of it this way. When the Fed buys these mortgage-backed securities or bonds, it is essentially swapping bonds for money. The Fed is going to take the bonds and then they're going to give the economy money. That's supposed to help the economy to grow. Now, when they do this, what happens is the bonds increase in price and interest rates lower. Conversely, when the Fed goes to sell those bonds, they're pulling money out of the economy and putting bonds back into the economy. That is going to cause the price of bonds to decrease and the interest rate is going to increase. Additionally, the Fed is planning on keeping interest rates lower. Now, that's not automatically good news for home buyers because the rate that they're referring to is the Fed funds rate, and that's the rate that banks charge one another to borrow money. It doesn't necessarily correlate to mortgages. Mortgages, however, are more closely attuned to the 10-year treasury. Now, even that isn't foolproof in this market because typically what's supposed to happen is when the 10-year treasury goes up, interest rates go up as well. However, since August of last year, the 10-year treasury has been on an upward trend and interest rates were going down up until about February of this year. And although the Fed said it wants to curb inflation, which is the rate of increase of prices over a set period of time, the almost $2 trillion stimulus bill has pumped exorbitant amounts of liquidity into the market. And that's really what it was designed to do. Federal stimulus is used to motivate business expansion and growth. So as stimulus money gets pumped out to businesses, it will help them to grow their establishments, which leads to them taking in more jobs. That is supposed to decrease unemployment. Also with that, as the stimulus money goes out to regular folks like you and I, it should increase our discretionary spending or the amount of money that we intend to invest or put back into the market. So they give us money, we're supposed to spend it and keep the economy growing. The goal is to make sure that as the federal government sends out money, it continues to circulate into the economy and the economy grows. However, if the economy grows too fast, then inflation rears its ugly head. And those inflationary fears sometimes cause the market to go a little crazy, which can make interest rates rise. However, the economy is looking more positive during this COVID recovery, and that is what is causing interest rates to go on an uptick. Now, when mortgage rates rise, housing prices typically fall. Yet, I just don't see that happening as we move into a very competitive spring season for home buyers. In fact, if interest rates continue to rise like they are, it's going to push a swath of people right out of the market because home ownership will no longer be affordable in their areas. Now, again, this affordability issue is being driven by a couple of different things. Primarily supply and demand. We don't have a lot of homes for sale and we have a ton of people who want to buy. And secondarily, it's driven by low interest rates. We're suffering from inventory constraints, above asking price offers, and just all out bidding wars. It's causing a lot of frustration to many first-time home buyers who fall in love with the home only to find out that there are 10, 20, or perhaps even 30 offers that are on this home, sometimes going for tens, maybe even hundreds of thousands of dollars above what the list price is. Or when a potential buyer sees a listing online, but they're not able to view it until after the weekend, only to find out by the time Monday or Tuesday rolls around that that offer is already under contract. Now, based on everything that I just told you, here's what I believe we're gonna see happen this year. Number one, we're gonna see a lot more offers come in sight unseen or subject to interior inspection. Essentially, home buyers are gonna just place an offer on the house that they haven't even stepped foot in, just as a way for them to get their offer in the door and just make sure that they're competitive. Because remember, I told you, sometimes you can't get into a house when it's actually scheduled to be shown because of your schedule. So why should you miss out on the house, right? So some buyers are gonna put in blind offers as a way to remain competitive in the market. Number two, I think the Fed is going to slowly raise the Fed funds rate over time to curb consumer lending, right? So again, the Fed funds rate doesn't have a direct correlation to mortgages, but it will have some trickle down effect as borrowing becomes less easy for some people. So when the Fed raises rates, it may have some trickle effect to mortgages, which if those rates go up and housing prices continue to go up, some people are just going to get priced out of the market. Now that's going to lower some of the competition. Will it be enough to spur some, decrease in home prices? I doubt it, but we may see some cooling off as we get closer into the fall months and even into the winter season, which typically is when housing kind of slows down. But again, we're kind of operating in a pandemic, so a lot of this schedule kind of got pushed a little further back. So we'll just see how that all shakes out. Remember, these are just my predictions. Number three, and this is going to sound really unpopular right now, but as a way to circumvent around a lot of these issues, I think some home buyers are going to jump into adjustable rate mortgages. Oh my gosh, Dietric, how can you say that after what happened in 2008? Well, I don't think we're gonna see the same type of things happen in 2008. It's become a little more stringent in terms of the credit requirements and all these other things. So again, I don't think it's going to be a major issue, but to get into home ownership and make it more affordable for some people, I think they're going to use adjustable rate mortgages, and then they're going to use savings to pay down some of the points and the fees that are associated with the loans. So I think we're going to see some buyers get a little bit more savvy in terms of how they create their financing in order to make home ownership more affordable for them. Number four, this really ties more into the inventory issue. I think as more vaccines continue to roll out and the numbers for COVID cases continue to decrease, that more home sellers are going to be less fearful about letting people into their homes and will start putting their homes on the market. Now, we found out last year that situation really put the kibosh on a lot of people who were thinking about selling, but when there was so much uncertainty about what this virus could do, how it was spread, it made a lot of homeowners who normally would have put their homes on the market, it made them take a step back and pause. Now, when the market didn't react like we thought it was going to react, because originally we thought when the pandemic hit, the housing market was going to shut down. Quite the contrary happened. As the pandemic hit and more people had to work from home, what they realized is that they didn't have the space to accommodate that. So that's what caused a lot of people to jump into, I'm gonna sell my home and upsize and get a larger home. It also caused some renters to say, I can't do this working from home with all these people around me and shared walls. I gotta get my own space. So that combined with low interest rates just kind of helps spur people into the mode of, I wanna be a homeowner now. The vaccines aren't necessarily rolling out as fast as we thought that they were going to roll out. Combine that with housing prices being high, some sellers are asking the question, even if I sell high, I'm going to have to buy even higher. So that's forcing some of them to stay put and see kind of where the market is heading. Now, can we time the market to tell people when it's the best time to sell, when it's the best time to buy? Not particularly. Only you as a home seller or home buyer can decide based on your circumstances and your needs when it's the best time to buy and or sell. However, I will say this, if you're thinking about selling and you want to cash out, this might be your window of opportunity in order to do that. Unfortunately, for many of you home buyers, this time, let's just be honest, I have to be 100 with you. It sucks because you saved up, you want to go into home ownership, you really want to pursue the American dream, but you got like 30 other people who are competing for the same house that you like. And some of them are offering $100,000 over the list price and waiving their appraisal contingencies, sometimes even their home inspections. And I just don't think this is sustainable for that much longer, but it just remains to be seen what's going to happen. I'm just giving you predictions on what I think is going to happen, and I'm not in any way trying to tell you, hey, you should do these things in order to try to, what I would say, game the system in effect. Is you have to sit down, know what you're financially capable of doing, and stick to it. I said in one of the last videos, if you're not ready, you're just not ready. Don't feel like you got to rush because interest rates are low or interest rates are rising, or your best friend just bought a house and they're telling you like, this is the best time for you to go, this is the best time for you to buy, or the best time for you to sell. Only you can make that decision. So make sure that you're making a very informed decision. And again, you know your scenario, you know your situation. Don't listen to anybody else who may be telling you contrary to what you already know that you can do. There are obviously some fears and concerns that a lot of you have out there. And sometimes it's good to just share those things with the community so you can bounce different ideas off of each other and figure out ways that you may be able to get into home ownership or sell your home without necessarily putting you or your family at a deficit or at a risk. So I think one of the next videos I'm going to talk about is the inventory issue, particularly from the builder standpoint, and why this is important, because we're seeing a lot of first-time home buyers who want to go into pretty much move-in ready homes. They're going for the new builds, but even that can be a little bit tricky, and I'm going to discuss that. Matter of fact, I'm going to discuss that in the next video. So make sure that you guys come back next week as I talk about new builds and how that inventory issue is also affecting the market and what you can do to kind of navigate around all that.